Welcome to the deep dive. We're here to basically pull apart the key ideas from important sources, really giving you that shortcut to getting properly up to speed. Today, we're doing a super focused analysis. We're looking at decentralized finance infrastructure, and we're using the book DeFi and the Future of Finance as our, let's say, our analytical guide. Our mission isn't just, a general chat about crypto. It's about taking this really deep framework from the book and applying it directly to what feels like the next big thing. Systems trying to move huge traditional finance processes, think mortgages, asset-backed securities, core settlement, moving all that onto a blockchain.
Exactly. And I think for you, the listener, the immediate takeaway here is that this book gives you the essential checklist. It's for assessing any project that's trying to manage real-world assets, or RWA, on-chain. We really need to get past asking, is this interesting or is this cool? We need to start demanding answers like, does this system actually replace the old, slow, kind of opaque traditional settlement and custody infrastructure? Does it genuinely boost capital efficiency and cut down counterparty risk? Because honestly, that's the only real measure of success here.
Right, the bottom line. So let's lay out the roadmap for today's deep dive. First, we'll unpack the core DeFi framework, the building blocks the book identifies. Second, we'll apply those ideas directly to RWA and on-chain settlement. We'll try and define some of that key jargon as we go. Third, we'll really dig into the functional questions the book says we must ask, especially around governance and control. And then finally, we'll pull together the key risks into, hopefully, an actionable due diligence checklist for you. Okay. Let's start with the fundamentals then. What are the big shifts DeFi represents? It feels like it's, more than just new tech. The book seems to suggest it's a whole philosophical change in how finance could be structured.
It really is structural. That's what the book argues. DeFi fundamentally introduces three key things: permissionless access, transparency, and this really crucial concept of composability. People often call these DeFi Legos. Think of them as like open source financial building blocks. They can be stacked, combined almost instantly into quite complex products, and crucially, without needing a bank or a broker sitting in the middle. So the whole idea of the movement is really designed to replace these centralized systems that are just, plagued by high fees, limited access for many, and often a lack of transparency. And to actually succeed, especially for institutional use, the book really boils it down to this. Any on-chain project needs to be assessed across three hard, non-negotiable dimensions. You basically have to score well on all three to be considered viable. First is capital efficiency. That's all about speed, yes, but also true cost, not just the fees they state, but things like slippage, other hidden costs, and, how quickly capital can actually be used and then redeployed. Second, risk and governance. This means looking really hard at the smart contract security. Is the code solid?
How reliable are the external data feeds the things we call oracles? And how does the system adapt or change its rules? Is that process transparent? And third, compliance and the real-world interface. This means, can it demonstrably integrate KYC-AML checks? And absolutely critical for RWA, are those on-chain agreements actually legally enforceable in the real world?
Those three pillars, efficiency, risk, compliance, that's incredibly helpful for, cutting through the noise. Okay, to make this a bit more concrete, the book mentions some core digital building blocks. Can you just briefly define maybe the big three for us? Stablecoins, AMMs, and collateralized loans.
Sure, absolutely. So stablecoins are basically the digital cash layer. They're cryptocurrencies designed to hold a price peg, usually to something like the US dollar. They're the medium for settlement on these platforms. They can be backed by actual fiat currency like USDC, or sometimes they're over-collateralized by other crypto assets like DAI.
Got it. Digital dollars, essentially.
Yeah.
What about AMMs?
Right. An automated market maker, or AMM, is the core exchange mechanism you see in DeFi. It's basically just a smart contract. It holds pools of assets, and it continuously quotes a price for exchange between them. This really removes the need for traditional exchange order books and, frankly, a lot of the friction that comes with them.
Okay, so it's like a robot market maker. And the last one, collateralized loans.
Yeah, collateralized loans in DeFi work by requiring borrowers to lock up excess assets as security. But the key difference is that the security, the collateral management, it's instantly enforced by the smart contract code. If the collateral value drops too low, liquidation happens automatically. This drastically cuts down the counterparty risk you have in traditional lending, where enforcement can be slow and costly.
That sets the stage really well. Okay, now let's take that purely digital framework we just discussed and try to apply it to these real-world assets, RWA things like mortgages or home equity lines of credit. This feels like where it gets really interesting for, serious financial infrastructure.
Exactly. This is where it gets interesting, partly because the traditional system is still, frankly, astonishingly inefficient in some areas. I mean, stock settlement still takes 2 days, T+2. International money transfers, remittances often cost 5 to 7% in fees. So the book's conclusion is pretty clear. The most valuable traditional roles for blockchain to potentially replace are those involving slow, trusted intermediaries.
Yeah.
Especially settlement and custody. Those are the big ones.
So when we talk about putting something like a house, or more likely the mortgage lien on that house, onto a blockchain, what exactly is the blockchain replacing? What function does it take over?
Good question. When we put RWA on-chain, the core value the chain provides is replacing primarily 2 functions. First, custody and registry. So instead of relying on traditional custodians or county recorders, you move the record of ownership, or the lien registration, onto a transparent ledger using tokenization. You might use something like an ERC-721 token that's a type of unique, non-fungible token on Ethereum-like blockchains to represent the deed or the specific ownership stake. This minimizes the risk of ownership disputes and makes auditing much easier.
Okay, so a digital representation of the ownership or the lien. What's the second function?
The second is clearing and settlement. And this relies heavily on something called atomic transactions.
Hold on, let's pause right there. That sounds important. We probably need a quick definition. What exactly is an atomic transaction in this context?
Yeah, great point. It's fundamental. An atomic transaction basically guarantees that 2 or more steps in a process happen instantly and simultaneously or critically. None of them happen at all. It's all or nothing. So in finance, this means you can have the instantaneous, irreversible transfer of value, say stable coins, and the asset ownership, the tokenized security, happen at the exact same moment.
Ah, okay. So I get the token precisely when the payment leaves my wallet. No lag, no settlement risk window.
Exactly. And this is huge because it drastically shortens the capital lockup period. We go from days in the traditional world potentially down to seconds.
So that instant transfer, that's where the real capital efficiency gain comes from.
Precisely. The book makes it really clear. The efficiency gains stem from, 1, near zero organizational overhead compared to traditional intermediaries, and 2, the use of these self-enforcing smart contracts. Automated clearing and this super rapid settlement, they're the main drivers of capital efficiency. Money just moves faster. Capital isn't sitting idle waiting for settlement. And you can imagine, in markets worth trillions of dollars, unlocking that idle capital, even for short periods. Well, that's the core value proposition. That's the potential multi-billion-dollar opportunity. However, and this is a big however, the RWA system's critical vulnerability, its Achilles heel, or its throat, as the book puts it, is that connection back to the real world. So for any RWA infrastructure project, the book tells us we need to check at least 3 crucial items related to this real-world link. First, Oracle robustness.
Oracles, right. Those are the data feeds.
Exactly. They feed external data, like asset prices, onto the blockchain. They're necessary, but they are a major systemic risk. So we have to verify. Does the system use decentralized data aggregation like Chainlink, pulling from many sources, or is it just relying on a single, potentially manipulable feed for crucial data like collateral valuation? Second, legal linkage. This is huge. Is the digital token legally enforceable as actual title or ownership against the physical asset? Or is it just, a non-binding digital representation like a derivative with weak legal ties? This needs to be crystal clear. And third, the identity KYC bridge. Regulation isn't going away. It demands KYC ML checks. So the system needs a compliant, hopefully seamless gateway for identity data to meet these real-world requirements.
That's a really powerful framework. Okay, let's try and stress test it a bit. Let's imagine a hypothetical project. Say it's aiming to put the entire mortgage lifecycle from originating the loan to slicing it into asset-backed securities, ABS, onto some kind of institutional blockchain. What's the essential flow that the smart contract system absolutely must replace to be compelling?
Right, so we look for functional replacement. For something like a mortgage loan, the smart contract system ideally needs to handle the whole abstract life cycle. That means the underwriting logic, or at least interfacing with it, then the asset registry and deed tokenization we talked about. Then moving to instant settlement and clearing, transferring the stablecoin funding to the borrower atomically with the lien and tokenization. Then facilitating the investor funding piece, maybe slicing that loan token into fungible, tradable ERC20 tokens representing shares in the ABS pool. And finally, handling the automated servicing, managing the incoming payments from the borrower, and distributing them automatically to the ABS token holders. The more of this entire flow the smart contracts actually enforce, the higher the potential efficiency and transparency gains.
Okay, and sticking with that example, what's the ultimate test for capital efficiency for the investors who might buy those tokenized ABS slices? How do we judge if it's really better?
I'd say the core test is liquidity. How fast, how easily, and at what cost can investors actually trade or exit their position in the secondary market for those tokenized ABS slices? The book uses the analogy, or maybe the gold standard, of flash loans in the purely digital DeFi world.
Right. Another key term we should probably define, flash loans. What are they and why are they relevant to institutional RWA? Seems a bit wild.
Yeah, they do sound wild. Flash loan is basically an uncollateralized loan, but it has one critical condition. It must be borrowed and repaid within the exact same atomic transaction block. So think milliseconds. It essentially allows sophisticated users to access vast amounts of capital, but only for zero duration risk. They borrow it, use it for some instant arbitrage or refinancing operation, and pay it back all in one indivisible step.
So you can't run off with the money.
Exactly. You can't run off with it because the transaction won't even validate if the repayment isn't included in the same atomic bundle. Now, the relevance for RWA is aspirational, perhaps. If institutional RWA markets could eventually enable similar kinds of zero-duration efficiencies, maybe for instant refinancing between pools, or complex arbitrage strategies that would demonstrate maximal capital speed, that would be a massive win for institutions.
Okay, shifting gears to the risk dimension. Governance often feels like the weak point, the Achilles heel of many centralized and even some decentralized platforms. How does the book tell us to scrutinize the governance setup in these potentially very complex RWA platforms?
Yeah, the book really hammers on this. The ideal is that founders must credibly renounce centralized control over the core protocol logic once it's live. Easier said than done, of course. So the specific questions we need to ask are critical functions like smart contract upgrades controlled by a single admin key that one person or small group holds? That's a huge red flag. Or are upgrades secured by mechanisms like multi-signature wallets and time locks?
Okay, let's break those down. Multi-signature wallets and time locks, they sound like security features. Why are they so important for governance?
Right. A multi-signature wallet, or multi-sig, simply requires multiple pre-approved parties, say 5 out of 7 trusted stakeholders, to all digitally sign off before a critical transaction, like a code upgrade, can be executed. It prevents unilateral control. A time lock is then often layered on top. It imposes a mandatory delay. It could be 24 hours, 48 hours, even longer between when a change is approved by the multi-sig and when it actually takes effect on the blockchain.
So it gives people time to react.
Exactly. These mechanisms are crucial because they provide time. Time for stakeholders, for investors, and very importantly for independent security researchers and auditors to review the proposed code changes before they go live and potentially cause economic harm, whether intentional or accidental. We also absolutely have to check if there's an emergency pause function, sometimes called a circuit breaker, and critically, who controls that mechanism, because that's immense power.
Got it. Now, you mentioned transparency earlier as a benefit. I understand that having the ledger be transparent is great for auditing, for seeing where funds are. But doesn't that transparency itself create new risks? Doesn't it expose the system's logic for attackers to study?
Absolutely. You hit on the transparency paradox. It's a double-edged sword. The transparency and auditability are, yes, immense potential benefits over opaque traditional systems. But, as the book warns, this very same transparency is exactly what allows sophisticated actors to plan and execute economic exploits. Things like flash attacks, where they manipulate prices or conditions within that tiny window of a single atomic transaction to extract value unfairly. So yes, auditing the smart contract code before deployment is absolutely critical. But even the best audits don't eliminate all risk. For any on-chain finance project, there are always residual risks. Primarily code risk, just logic errors, bugs that might brick funds or allow unintended behavior, and, as we keep mentioning, that Oracle risk, the reliance on external data. Those remain the top threats. And actually, there's another layer of, let's call it cost and risk we need to be aware of. MEV.
Okay, another acronym. What's MEV?
Right. MEV stands for minor extractable value, or sometimes maximum extractable value now with proof-of-stake systems. It essentially refers to the sort of hidden profit that the block producers, miners, or validators can potentially squeeze out of the system by strategically reordering, inserting, or even censoring user transactions within the blocks they create.
So they can front-run trades or sandwich attacks.
Precisely. Things like front-running large trades, sandwich attacks where they place orders before and after yours to profit from the price impact. It happens. And this adds a subtle, often invisible, non-protocol cost to using the system. So astute investors need to evaluate not just the officially stated protocol fees, but the total transaction costs, which might include some level of MEV extraction, to get a real sense of the platform's true efficiency.
Okay, that's a crucial, subtle point. Now let's try to synthesize the book's broader risk chapter, bringing it directly into this RWA infrastructure context. What are the really big systemic risks that maybe even robust governance can't fully eliminate?
Well, beyond the risk within a single smart contract, the book highlights systemic composability risk. It uses a fantastic analogy. When these decentralized applications, these DeFi Legos, stack on top of each other, the weakest link in the chain can bring down the entire house. Think about it. A failure or exploit in one core component, maybe a collateral pricing mechanism or a stablecoin, could potentially cascade and contaminate entire pools of assets or related applications that depend on it. A failure in one Lego piece can make the whole structure unstable.
Right, the interconnectedness creates new systemic pathways.
Exactly. Then there's scaling risk. This is a constant background threat for many blockchains. If the underlying blockchain, the base layer, can't handle a high volume of transactions per second, TPS, especially during market stress, it creates congestion. Fees spike, transactions get stuck. And this congestion can be absolutely lethal for time-sensitive financial operations, especially things like liquidations and lending protocols. If you can't liquidate underwater collateral fast enough because the network is clogged, it can lead to protocol insolvency. Milliseconds matter there.
Okay, and given that RWA projects depend so much on factors outside the blockchain itself, where should our focus be regarding those external risks?
Yeah, for RWA specifically, the biggest external risk points are probably regulatory risk and, again, Oracle risk. Regulatory uncertainty is a killer. A project can have perfect code, perfect economics, but if regulators decide its structure is non-compliant or issue unclear guidance, it can be forced to shut down or pivot dramatically. We've seen examples with certain stablecoin projects facing major hurdles. And the Oracle risk for RWA is perhaps even more direct. If the price feed for the underlying collateral, say the value of tokenized real estate or the interest rate benchmark, gets corrupted, manipulated, or simply suffers an outage, well, the smart contracts rely on that data for liquidations, for collateral management. They instantly break down. The logic fails.
That makes sense. So inevitably, bad news will hit some of these projects. How does the book advise us, as investors or analysts, to assess the severity? How do we distinguish between, say, a minor bug that's quickly fixed and a really fundamental catastrophic flaw when we read headlines about exploits or issues?
That's a critical skill. The book offers a really useful 5-point diagnostic checklist for interpreting bad news. The key is understanding the type of failure. So when you hear about a problem, ask yourself these questions. 1, was this a fundamental vulnerability in the core smart contract logic itself, like a math error or a reentrancy bug?
Was it an Oracle failure? Did the price feed get manipulated or just go down?
Was the exploit significantly enabled by flash loans or similar atomic transaction tricks?
Was it actually a governance failure, like a malicious proposal passing or someone abusing an admin key?
Or was it purely an external regulatory action that effectively killed or crippled the project?
By figuring out which of these categories the failure falls into, you get a much better sense of whether it's a fixable operational issue, a deep design flaw, or an external shock. It helps assess the project's resilience, its anti-fragility.
That's a super practical tool for cutting through the FUD, the fear, uncertainty, and doubt in the news cycle. Okay, let's wrap this deep dive up now with the most actionable takeaways for you, the listener. How do we really distinguish the genuinely valuable, sustainable innovation in this RWA infrastructure space from projects that might just be driven by, unsustainable token inflation or hype?
Yeah, the book is really adamant on this point. You have to be wary of systems whose main attraction relies heavily on yield farming, basically, distributing inflationary tokens just to bootstrap initial liquidity or attract users. Sustainable cash flow, real economic value must eventually be generated by things like transaction fees earned from genuine platform usage or some inherent business utility that people are willing to pay for. It can't just be about printing tokens to pay participants. If the whole thing collapses the moment the token subsidies stop, well, it was never really sustainable infrastructure in the first place.
Right. Look for the real business model underneath.
Exactly. So we've condensed the book's core principles into what I think is a crucial 9-point due diligence checklist. You should really use this when you're examining any company or project building on-chain financial infrastructure, especially in the RWA space. 1. Functionality. Ask, what specific traditional process is this system entirely replacing with smart contracts? Be precise.
Efficiency. How much is the clearing or settlement cycle time truly reduced by? Get actual numbers if possible.
Cost. What are the real protocol fees plus any potential hidden costs like estimated MEV? What's the all-in cost?
Resilience. How is the system designed to handle liquidations, especially during extreme market volatility or network congestion? Have they stress tested it?
Governance control. Critically, what are the contract upgrade permissions? Is it secured by robust multi-sig wallets and significant time locks?
External data. What is the Oracle source for critical data feeds? How is it designed to resist manipulation?
Legal linkage. Is that digital token legally enforceable as actual ownership or title? Or is it just a derivative with questionable standing? Ask for legal opinions.
Compliance. What's the specific integrated KYC-AML solution being used? Is it robust and compliant in relevant jurisdictions?
Cash flow. If there's a native token, does it derive tangible value from sustainable fees generated by actual platform utility? Or is its value mainly driven by inflation and speculation?
That's a very thorough list.
And maybe beyond that list, just look for 3 clear signals that might indicate a project is achieving real scale and maturity. 1. Robust external audits of their smart contract code from reputable security firms. 2. Verifiable compliant on-ramps and off-ramps, especially for identity data and fiat connectivity. And 3. Sufficient secondary liquidity depth for the actual tokenized assets being traded on the platform. If people can trade meaningful size without moving the price too much, that's a good sign.
This has been an incredibly focused deep dive. Really appreciate you walking us through how to apply that kind of high-level analytical rigor drawn from the book directly to this emerging world of institutional blockchain infrastructure.
My pleasure. I think the single overarching takeaway, synthesizing the book's core argument for this context, is this. DeFi, when it's properly applied to real-world assets, it isn't just another financial product fad. It's potentially a complete rebuild, a fundamental re-architecting of the financial industry's core clearing and custody operating system. It aims to replace slow, manual, trust-based intermediation with transparent, automated, programmatically enforced certainty. That's the promise, anyway.
So your action item, listener, is to take that 9-point checklist we just went through, use it, apply it rigorously when you analyze the white papers, the investor materials, the websites of any on-chain infrastructure project you come across, especially those dealing with RWA. That list, I guarantee, will instantly elevate your analysis way beyond just the surface-level headlines and get you thinking about the core mechanics of how or if real value is being created.
We hope this has been valuable. We'll see you next time for another deep dive.